So get this, what if getting out of debt actually landed you with a surprise tax bill? I know, it sounds wild, but it's a hidden financial trap that catches so many people. Today on The Explainer, we are going to break down the shocking tax consequences of debt forgiveness and, more importantly, how you can steer clear of them.
You know that feeling of debt just hanging over your head? It's heavy. It weighs on you, it stresses you out, it makes you feel completely stuck. So when you finally manage to negotiate a settlement, you see that light at the end of the tunnel, and the very last thing you'd ever expect is for that feeling of relief to create a whole new problem.
It feels totally backward, right? But it's a real thing that happens to millions of people. That amazing feeling of settling a debt can instantly flip into the stress of a new tax bill. In this explainer, we're going to unpack this whole debt forgiveness tax trap and give you the playbook to navigate it.
All right, let's get right into it. First things first, we need to understand the problem itself. What exactly is this tax trap, and how in the world does it even work?
Here's the deal. Let's say you have a $10,000 credit card bill. You negotiate with the company and you settle it for $4,000. Awesome. But that $6,000 difference, it doesn't just disappear into thin air. In the eyes of the IRS, it's as if your creditor just wrote you a check for $6,000. And yeah, it's a shocking rule that catches people completely off guard. So you're probably asking, why? Why on earth is this a thing? Let's break down the logic behind it and the actual process that turns your debt relief into a potential tax nightmare.
It all comes down to this official IRS term, Cancellation of Debt Income, or COD income for short. From the IRS's perspective, you just received an economic benefit. I mean, think about it. You were obligated to pay that money, and now you're not. That financial gain is treated just like any other income, and as we all know, income gets taxed.
And this is pretty much the bureaucratic journey it takes. It all starts when you settle that debt. Then, your creditor will often issue something called a Form 1099-C. That's the Cancellation of Debt form. And here's the kicker. They send one copy to you, and another one goes straight to the IRS, officially flagging that forgiven amount as income on your record.
Okay, so that's the bad news, but here's the really good news. The story absolutely does not have to end with you writing a big check to the IRS. There are specific legal escape routes that are built into the system to help you avoid this exact trap. This right here is where being in the know completely changes the game. Understanding these exemptions is the key, the absolute key to settling your debt without accidentally trading one financial burden for another. Now, the two most powerful tools in your toolbox here are insolvency and bankruptcy. You're considered insolvent if, at the exact moment the debt is forgiven, the total of everything you owe is more than the total value of everything you own. If that's you, you can often exclude that forgiven amount from your income. Bankruptcy provides an even broader shield. Any debts that are discharged in bankruptcy are generally not considered taxable income, period. Okay, so we know the rules, but how do we turn all this knowledge into an actual, actionable plan? Because knowing this stuff is one thing, but applying it is what will really protect you. First step, and this is non-negotiable, you have to do a complete and brutally honest assessment of your entire financial picture. We're talking a detailed list of every single asset and every single liability. This isn't just about feeling organized. It's about doing the math to see if you qualify for that insolvency exemption we just talked about. Next up, and I cannot stress this enough, you have to become a record-keeping ninja. Every email, every letter, and especially that formal written settlement agreement, it's all vital. Think of this documentation as your proof, your evidence. It's your defense if the IRS ever comes knocking and asks why you claimed an exemption. And that brings us to what might be the most critical step of all. Don't try to go it alone. Please, get professional help. Tax law is a jungle. It's incredibly complex. A good tax pro can confirm if you're truly insolvent, make sure you file the right paperwork, like the crucial IRS Form 982, and offer guidance that could literally save you thousands of dollars.
You know, successfully navigating this whole process isn't just about solving a problem from your past. It's really about laying down a solid foundation for a much, much better financial future. The real win here is building new habits that create lasting stability. We're talking about a real, sustainable budget to get control of your cash flow, creating an emergency fund so that life's little surprises don't send you back into debt, and maybe most importantly, truly embracing a new mindset where money becomes a tool for empowerment, not a source of stress. So here's the bottom line. The single most important takeaway from all of this is that you are now equipped. You get the trap, you know the legal ways out, and you have a clear plan.
You are now in the driver's seat, ready to take charge of your financial journey and turn this challenge into a real opportunity for a fresh start.
We hope this explainer has really shined a light on the path forward. You know how to get out of the trap, so the only question left is, what's that very first step you're going to take? Thanks for joining us.